there's clearly a dividing line between the kind of data this Fed appreciates, wants to see, it's objective, and what you think is undesirable. And what I sense from you is that we're creeping towards the latter and moving away from the former. And if that's the case, isn't the 10-year Treasury in your mind a screaming buy right now?
The 10-year Treasury in my mind is a screaming buy. I think that from here, the path forward for nominal 10-year yields is going to be lower for two reasons.
Oh, slow down. I got to take notes here. Screaming buy.
for two reasons. One, the Fed's credibility is being reestablished as an inflation fighter, and that will put downward pressure on break-evens. And one of the reasons that real yields are where they are is because break-evens haven't repriced higher. Think about Jackson Hole. They're holding the 2% inflation target. They're doing everything that they can to convince the market that they're here for the long haul in the battle with inflation. So if we believe, which we do, that there is still a 6 to 9 month lag of monetary policy actions hitting the real economy, the second half of this year is going to be pivotal for the effectiveness of what Powell has been attempting to do.
So is he saying load the boat on the 97-year Austrian?
Not
is that
quite.
What I heard?
Not quite. Not quite.
Is that how I translate that?
10-year Treasury
I got to make some money here.
And I think we've got to put some numbers on it. Difficult to do, I know, but I just want a better understanding of the direction here and what you're looking for. Right now, north of 4%. We got through 4.30 in the last week or so. What are you thinking about? 3? Could I go to a 2 handle? What kind of numbers are you thinking about?
I think that we do get 10-year yields back to 3%. I don't think it happens this year. I think that that will be a first half of 2024 event, but we can easily close in a range of 350 to 375 by the end of this year.
And that's not just monetary policy dependent either. It's fiscal as well. Treasury's still issuing a ton of debt. We have a deficit spending that we need to fund. How does that factor into this equation?
I think that what primarily sets the outright level of Treasury yields are the global macros of inflation and growth. The incremental supply considerations will lead to concessions in and around the events themselves. And frankly, the market knows that there's a bunch of Treasury issuance coming. We have that largely priced in. The Treasury Department has been very clear in their signaling. And still, we have 10-year yields at 4.15, not 5.15.